Anand heads PMS and AIF investment in ICICI Prudential Asset Management Company. He has more than 2 decades of rich fund management experience in the asset management industry. Most recently as a CEO of NJ Asset Management. Prior to this, he was Deputy CEO and Head of Investment at BNP Paribas. And he was overseeing both onshore as well as offshore mandates, sub-advised and sales. So he has won a lot of laurels and prestigious awards for his fund management. He was a recipient of CEO of the Year Award 2014 and 15 from Asia Asset Management, and also won multiple other fund level award for his investment performance. By qualification, he is a MBA from IIM Lucknow and holds a BE degree from Regional College Surat. So without much ado, Anand, I'll open the floor for you. But Anand, let me just set the context here. Today, what we thought we will try to understand and get a perspective. So I was recently reading Howard Marks' memo, and this memo was a very interesting one, right? Talking about sea change. And he spoke about what has worked in last 20 to 30 years might not work going forward. So I wanted to kickstart with your views on the same. Are we expecting a much heightened volatility and dynamism going forward? I know investing is a philosophy, right? Everybody has their own set of philosophy. So we wanted to know how you look at investing. What is your philosophy? What is your take on investing? So over to you, Anand. Thank you very much.
Sure. Thanks, Tarun. Thanks for the kind introduction. And once again, sincere apologies to one and all if you had to wait very long because of the technical handicap that we had at our end. So nevertheless, let me then not waste more time and jump. So what I'll do, Tarun, next half an hour, I'll try to shrink it in 20 minutes so that we have enough time for Q&A. I'll share with all of you in terms of, what has not changed and what has changed. And I'll keep it simple. The complicated stuff on the markets can get very complicated as you move near term. Once you expand the horizon, the market is simple. But as we come closer and saying, kya lagta hai in next 2 years, in next 1 year, then it becomes complicated, and we'll cover that in Q&A. But the moment so let me start with few slides, and then let's see, Tarun, how it goes. And
Sure.
I hope those slides cover 80-90%, and then maybe we can then do the rest in the Q&A. But you will be the best judge whether, what is it saying? Screen mirroring, active start broadcast. It will be recorded, enabled to start broadcast. Unfortunately,
you can share your screen.
One second. I'm not able to share the screen for some reason. My sincere apologies. Somebody will have to help me. Then I think let me try once more, because it is recording. Recorded, enabled, screen broadcast.
So, Anand, don't worry. Anand, I have the presentation. Let me run that for you.
No, that would be awesome. Thank you very much. So, this is perfect. Thank you very much. And quickly move to the next slide. And this is the slide which is, to me personally, the most important slide. I've spent now 22 years plus, almost 23 years in next 2 months in this market. And in last 23 years, every time I've done meetings, people ask, kya lagta hai? And this one graph tells you, ke acha hi lagta hai. In the sense, look, market has delivered, in terms of wealth creation. It has done its work. 14% CAGR over a long period of time. And if I go back into the history, it included .com bubble bust. So the tech disaster, somebody who has been in the market in 2000 would know the tech NAVs went to 3 rupees and 2 rupees. So we are talking about 70% and 80% fall in the mutual funds. So imagine the stocks would have fallen 90-95%. Then we had obviously India Shining campaign, and subsequently post the India Shining campaign, you had a big loss of the then Prime Minister Vajpayee ji, and we had a lower circuit. So that lower circuit, the fall of NDA-1 government doesn't look like, but it was very painful on that day. Then obviously, then you had a Manmohan Singh era, and then you had a Manmohan Singh victory, which led to upper circuit, and then obviously the GFC and subsequent pain. But we lived through those pain, and then more recently it was a demon and the GST implementation, and very recently was COVID, and further recently was the Russia-Ukraine crisis. So I think we have seen it all. We are not even talking about the 9/11 that we saw, and a lot of domestic and global elections that went past. Not to forget, there will be 23 budgets in that. So I think we have seen it all, and yes, I wish the journey was more of a straight line, but it is not, and that's the beauty of this market, that it's not a straight line, and that's why it's both an opportunity as well as a risk. So if you don't anticipate volatility, if you don't anticipate corrections in the market, then you are in for a risk. But if you have anticipated, that can work in your favor. I'll give you one more example of, people ask me, will there be a correction? I tell people correction is like whether the sun will rise tomorrow, because in the midst of a raging bull market of 2004 to 2007, we had 6 corrections of more than 10%, and one of the correction in 2006 was 30%. So even in the midst of raging bull market, you would have 10 to 30% correction. So correction is the part and parcel of the market. It will invariably correct. So with that simplistic view, let's go and complicate the matter. But I thought this is the most important slide for me, that eventually the wealth is got created. If you're prepared for the corrections, if you're prepared for the volatility, you can work it in your favor. But if you're not prepared, then it works against you. So the next slide, Tarun just tells, where this natural direction of the market is up, is what I'm saying. That generally the market's tendency to go up comes from the simple formula of price is equal to EPS into PE multiple. Tarun, we move to next slide. So this is as simple as, again, I'm not complicating. There's a DCF, there's the cash flows and whatnot, but let's keep it simple, and then obviously we'll complicate it. But this is as simple as it gets. And the natural direction of the market goes up is because the natural direction of the EPS is up. In an economy like India, where we have 10 to 11 to 12% nominal GDP growth rate on the back of 5 to 6% inflation, 6 to 7% real GDP growth rate, obviously the EPS is going to move up. So that gives you the natural direction. The P multiple gives you all the volatility. But again, there is a science. We'll cover that at a later stage, how we can make money off P multiple also. So I'll come to that. Quickly moving on, the faith, the thesis by which we live, which is again very important. And if you can skip a couple of slides and move to the slide which says, companies create wealth, not markets. If you see the next slide, this is another very important point I'm making. You can make a note of it. But at the end of the day, the constituents of the market don't go up because the market is going up. What I'm saying is, it is not that because Nifty is going up is why the HDFC Bank, the Infosys, the Reliance, the Sun Pharma of the world will go up. No. It is because the HDFC banks, the Infosys and the others do well, because they go up, is that the Nifty is going up. So Nifty is a derived element. Nifty is not the driver. What I'm saying is, if you see this data in every market, and these are the rolling 3-year returns, you can do the same work for rolling 5-year returns. You can do for the same. In every market, the good market, the bad market, the ugly market, and the very good market, where you have 23% return on Nifty 500, even then, you have 60% of the market which has done better than 20%. There's a 40% which has done badly. So in every good and the bad market, you would make money or you lose money depending on the stocks you have. I think that's another not well understood. We continuously debate and discuss Nifty. Nifty is a derived number. Similarly, we debate economy. Kya lagta hai? Economy is a derived number of how the constituents of economy are doing. How is Infosys doing? Is it delivering services to the global companies, in the process earning enough to pay the salaries to the IT services employees? Is HDFC Bank able to make money by lending? I'm generally giving you names, but whether Sun Pharma is doing enough work that it is curing patients in the process, it's a win-win. When companies deliver value for their goods and services, not only they make money, their consumers also benefit. And that's a virtuous cycle. So please understand and the next slide actually says it all. If you see the next slide, look at this. This is, so there are companies where, so the drivers, if you recall, I showed you in the previous slide, the driver of a stock price is delta EPS, which is the third column, if you see. All the wealth creating, our responsibility or our job or our endeavor is to identify the stocks which are on the top 3 rows and to avoid the stocks which are at the bottom 2 rows. To be very honest, our endeavor is to identify companies which are in the top 2 rows, which is delivering more than 10% return, and avoid companies over a long term, which will deliver less than 10% CAGR. And if you see, the combination is very clear. Can we identify businesses which can grow EPS, grow profits far better than the benchmark, far better than the economy, but also the return on equity is on the way up, which drives the PE multiple. Again, the PE multiple is a function of return on equity, cost of equity, and growth. Simple. So very clearly, and I will show you subsequently in few of our slides, that it is only 2 things that matter. Delta EPS. Do you have companies which will grow earnings? Second, do you have companies which will grow return on equity? Right? Again, I know this is more complicated than what one would want it to be, but nevertheless, we'll come back and simplify it for you in a while. But this is as simple as that. We can move a couple of slides. The short-term view actually don't matter. It keeps on changing. To be very honest, 2023 from my perspective is better than 2022. 2022 was very brutal. 2023 is much better, maybe from April onwards, because we will see a softening of the interest rates, normalization of economy in China and Europe, and more importantly, in India also, we should see some rate cuts in the second half, and things would get normal, notwithstanding what's happening in the markets over the last 2 days. So we can move. I want to share 3-4 slides, and I want to share with you something which is more important. That's how we see market very differently, which is there is a significant trend change. This is where, Tarun, you started saying that Harvard Marx said that what is work will not work. This year we genuinely believe that. Our portfolios for last 2 years have been running a portfolio of very differentiated stocks versus the rest of the market. Obviously, we have also got that sort of alpha. But if you move a couple of slides down, 2 things. Go ahead. Yeah, so we are actually making a statement that we're clearly saying that the trends have changed. And let me share with you what trends are we talking about. But this is more a medium-term view on the market, which is more important. If you move to the next slide, one big picture, that while the macros prior to December 2019 were more benign, you didn't have inflation, you didn't have COVID, overall things were fine, interest rates were fine, you had completely difficult bottom-up story in India. The earnings growth was missing. So if you see the middle table, over a 5-year period, practically EPS CAGR was 0. Big, large cap, mid cap, small cap. surprise, surprise, in the most difficult phase of macro, which is the COVID wave 1 and the subsequent 3 months, 4 months lockdown. Then we had a COVID wave 2, which is a Delta wave. And then, we had very, very difficult times. We had a mini lockdowns in the second phase, and then we had a Omicron, and then we had a Russia-Ukraine crisis leading to significant inflation, increase in interest rates, and the dollar strengthening all coming together. In that period, if you see, the earnings growth is very, very low. What has changed? I think that is very important. Something has changed, and that is what one needs to understand rather than worrying about or enjoying the market, rather celebrating the India story or worrying about India story. Let's understand the constituents within the economy, how they are performing. So if you move to the next slide, Tarun, what has changed? This is very important. That there was an era, and this is not last 5 years, it was almost a decade and a half, when China would manufacture for the rest of the world, including India, whatever you want at extremely low prices, which meant that consumers were doing well. And to that extent, the consumer-facing businesses were also doing well. But the manufacturers were suffering. So you had a very small set of businesses which were doing extremely well, which for the simplicity's sake, I'll say consumer-facing business like B2C. And then you had a large part of the economy, which is manufacturing, mining, manufacturing allied like infra, utilities. They were all suffering. So you had earnings growth rate in one segment of the market, you had zilch earnings growth in the next segment of the market. What has changed? Nothing has changed on January. Previous slide. If you see the right-hand chart, what has changed is not that it has changed that day, but it has been changing for a while. It's China's lower labor cost, China's lower energy cost, China's lower pollution cost, and China's supportive government. Everything has evaporated over the last few years. In the sense, the government's support for manufacturing exports has now down to almost zero. Their labor is becoming expensive. Their energy costs have become very expensive, particularly in 2020 onwards. And their pollution costs have been going up since 2014. So all of a sudden, manufacturers in deflation, what deflation China exported to the rest of the world evaporated. And now China is exporting inflation, which means anybody who survived the Chinese deflation for a decade and a half is doing extremely well. And consumer-facing businesses, while they're doing well, they have to take a lot of price increases to maintain margin, which is suffering them on the volumes. Now they have to manage a balance between volume growth rate and margins. If they want volume growth rate, they have to sacrifice margins. If they want margins, they have to sacrifice volume. And that's how that's a balance. So quickly moving, if you can jump a couple of slides, what has changed? Move on here. This is what is changing, the previous slide. That, if you see, this is a beautiful chart which shows how in the period from 2015 to 2019, you had auto doing the best, followed by energy, FMCG, metal, commodities, blah, blah, blah. And the banks delivered minus 4% CAGR in earnings in that 5-year period. And subsequent period, if you say, it's almost opposite. Autos are suffering on the back of high metal prices. Energies are okay. FMCG is slowed down in terms of earnings growth rate. Metal, commodities, infra, bank, they are all doing well. IT pharma obviously benefited because of the COVID, and that's sort of reversing in a while. So that's what I'm saying, that there has been a trend change. And that reflects in our portfolio, how our portfolio is designed very differently from others. I just wanted to give you this spill or this sort of thinking that is derived, and we believe, a lot of people believe this is temporary and this will reverse. And that's where we are different. We believe this is here to stay. China is not going to be the manufacturing leader forever. It is going to give away, and it's been going away, continuously giving away to Vietnam and the Burma and the Bangladesh and Cambodia and but India is bound to be there. So if you see the next slide, the market performance is not very different. So if you see the stock price performance, while it is different, but it's not very different because the people who suffer on the earnings, they also did well because the P multiples went up. So if you see bearing, bank, metals, commodities, not even commodities, metals and commodities where the P multiples are lower, everywhere the P multiple is higher. So overall, while the Nifty P multiple has come down, the B2C businesses P multiples have actually gone up, be it pharma, IT, FMCG, auto. So if you move to the next slide, this is what it is. And I will stop here and we'll move to more of a portfolio level and how we work upon identifying businesses. But this is my last slide on the market, which says that while market is at a new high or near about new high, and it's been up 22% since 1st April 2021, it's not irrational. The market is not irrational. Market is cognizant of the challenges that the economy and the markets face, especially in the light of stronger dollar and higher interest rates. The PE multiples have come off. Now, can this PE multiple can come off further? Can it go below 21? It can. There's no denying that it cannot go. But I'm just saying that it's not that we are at a new high of the market and from here the market is to fall because we are all euphoric. No. I think market is same. Investors are cautious. The advisors are cautious. Even the fund managers are cautious. So I think that's a good news in terms of where we see the market is. Moving on, I think we'll touch a little bit upon how we work and how do we try and add value. So, 5 minutes around that is, as I said, we have to identify businesses which will have delta EPS and delta PE multiple. We have a framework called BMV, the framework which entails about identifying businesses which will grow earnings growth faster than the market, but sustainable. So we're looking at both growth as well as moat. Moat is nothing but a sustainable company. So every business that we invest in needs to have a growth, obviously, but needs to have a sustainable competitive advantage in each company that we invest, which allows it to survive the difficult times and thrive in the good times. Now, again, easier said than done, but this is a continuous exercise that we do. We have a large team of analysts which does that. And last but not the least, we need to see industry consolidation versus fragmentation. I think that's also a very large driver of wealth creation. So in business, we look for growth, we look for moat, and we look for industry consolidation, basically the business changes that are happening at the sector level. Once we like the businesses, when we go to management and valuation. Never ever an analyst or a company or a fund manager can start with a valuation saying stock is cheap. We are not in the business of buying cheap stock. In the business of buying good management run by reasonably good businesses run by reasonably good management at a reasonable price. So again, we are not of the extreme school where it's saying good business, good management at any price. No. We will endeavor to buy good business, good management at a reasonable premium. That is what it is. So that's the core philosophy with which we run. If you see who all supports us in the subsequent couple of slides, and in the team, myself, Choka, Gitika, Suraj, we all further. So if you see every stock that gets bought into the portfolio goes through 3 levels of filter. One is that army of analysts which identifies 470 good companies. Then our team of fund managers and analysts within the PMS AIF identifies 100 good companies where we have an opportunity of delta EPS and delta PE multiple. And that 125 companies are further, screened to arrive to a 25-30 companies by the fund manager. So every stock that we buy has to go through 3 filters. What it does, it doesn't reduce the volatility. I would not say that we have less volatile portfolios, but it reduces risk. One is to differentiate between risk and volatility. Risk is a permanent loss of capital. Volatility is a temporary loss of capital. This is where we've been more overweight. And this has been the driver of the alpha that we have achieved in last 2 years, driver of all the performance that we have been able to deliver to our investors in last 2 years is we've been more focused here And when we started 2 years back, talking about manufacturing, we were the only voice in the market. Today, we see more voices, though not fully. We are overweight here. We are overweight manufacturing and manufacturing allied, which is including industrial products, capital goods, utilities, banking. People are forgetting a large part of pain in the banking from 2015 to 2020 emerged from manufacturing, infra, utilities. The same is going to reverse. So we have a lot of banking also in our portfolio, and logistics and many more businesses. So this is the piece which we have in our portfolio, which has been sort of driving. Yeah, this is what I wanted to stop here. And what do we do? So again, coming back to the delta EPS and delta PE multiple, and that at a reasonable price. This is our portfolio. If you see the top two rows, the contra and the pipe strategy, we have strong earnings growth rate, 3-year, 1-year CAGR, you can see. It's a reasonably good earnings growth rate, but more importantly, we are obsessed, or let me put it this way, we are conscious that the businesses have to have a reasonably good return on equity to get valuations, to get PE multiples, to get respect, and which comes from the moat. So when you see the ROEs of these businesses over the last 2 years have inched up to 18, and that is what we continuously debate with the management, continuously debate internally, whether this ROE is inching towards 20, 25, that is which will drive the rightmost. So if you see, when we bought this portfolio 2 years back, this portfolio was around 13 PE multiples. Over 2 years, we had a strong earnings growth rate, but the portfolio also did very well, but it has underperformed the earnings growth rate. So the PE multiple actually has come off, and that's been giving us confidence to continue to stay with the portfolio as the portfolio's earnings growth rate outperforms its stock price performance, and that keeps it reasonably priced. But more importantly, what gives us confidence is our expectation that the company's earnings profile remains strong at a portfolio level, and the ROE profile remains strong, and the valuations are reasonable. So all three things that we spoke about, we've sort of covered it. So I'll stop here. And Tarun, hope this was enough to spark some questions, or maybe.
Thank you, Anand. This was interesting, and I'm sure we all got a flavor of your style of investing and how you have been. And I was checking a lot of your performance number in a lot of categories, right? So, and I've seen you have in last 3 or 5 years, your funds have outperformed by a good margin, right? So let me come to straight, because I feel the views on market, as you said, it's a joke, right? Nobody knows what is going to happen, right, tomorrow. So I think rather than spending more time on that, let's spend more time on the philosophy part. And I wanted to understand your portfolio construction style, turnover style, sizing style. I think these are, according to me, are very critical decision. And how do you determine the sizing decision in terms of how much percentage to allocate to each stock? Can you elaborate how you approach portfolio construction, and how do you look at portfolio turnover and average holding period of a stock? Because according to me, these sizing decisions are one of the most critical decisions. That's where an individual investor versus a seasoned portfolio manager differs. Because as an investor, I may not size something correctly, but you as a professional fund manager has that expertise. So maybe you can give some insights there.
So let me start first with the churn. There is a lot good debate around the churn, and to be very honest, look, every stock that we buy, we are very clear we are buying it for good. The intention is not to sell, until there's a reason to sell, and I'll come to why we sell whatever we sell. Let me start with that. The intention at the time of buying is to buy stock for good and have growth, moat, leadership in place for it to continue to survive and thrive for next 5, 10, 15, 20 years. And to that extent, there might not be reason to sell these stocks ever, including I'm talking about. Having said that, Having said that, there are businesses, and stocks where either business changes, management changes, or valuation changes. So the BMV is the reason why we buy. We buy strong, good businesses. If the business deteriorates for the worse, we get out. If the management change is such that it deteriorates, there's a change of management or a change of CEO or those, and we believe it's not in favor of, or there is a management decision which is not in favor in minority shareholder, we would not shy away from selling. And last but not the least, generally the reason why we sell is when the valuations move far too ahead that you actually don't expect to make money for 3, 4, 5 years. Then obviously we would look for a better opportunity. So it is the same reasons why we sell. Churn in our portfolios have, on an average 3 to 4 years is what you look at. I believe zero churn is too bad. Similarly, a churn about 25% is also not good. You should expect us between 0 to 25% of churn, which is on an average a portfolio company stays in the portfolio for 3 to 4 years. So that's what you can look for. Coming back to sizing, again, sizing is a combination of many things.
And Anand, do you think sizing is an important part? I wanted to get your views on that also. Do you feel sizing is a very important decision?
No, I don't think so. To be very honest, we have done a lot of study, and equal weight Nifty might not be as bad as the Nifty. Might be better than Nifty. So at times, fund managers' ability to believe that fund manager knows exactly when to buy, I'm not in that camp. So to that extent, it doesn't matter. We have to first and foremost identify 25 good stocks. After that, what happens? Sizing works when actually we get opportunities in the businesses that we already own, we already track, and for wrong reasons, they are falling significantly. Those are the opportunities we can capture. My best money-making ideas have been ideas where actually the market has not worked for us in the first couple of years. So you have identified good business. It was good business, good management, reasonably priced, and still the stock either fell significantly or didn't create wealth for 2 years. That is the stocks which have made the most money for you, because then they become so attractively priced, you can size them better. Similarly, sizing also works when actually you really like the business and you really like the management, but the valuations are not comfortable. That is when we actually, at times, take a tough call, but we do it with a very little sizing. So we really want to own that name. That name deserves to be part of the portfolio. It's just that in the near term, the valuations are fairly steep and you can have a 1 year of price correction or a time correction. We start with 100, 150 points and then scale it up. So sizing works in the favor of investor. Whenever we have adverse movement in the stock price, that works beautiful.
Okay. And how do you approach portfolio construction? So whenever you, let's say I as a client give you the money. So how do you approach a construction of a portfolio?
No, the first and foremost, we have to understand one, for the PMS AIF, we are more index agnostic. Practically, we are index agnostic. So it's not so much of a top-down portfolio. It's very much a bottom-up portfolio. We do start with a 28 to 30 stocks, and then gradually it moves towards 25 stock portfolio. So every new investor who comes in, most importantly, please understand, we don't do asset allocation. So here we believe, and that is our belief, that between advisor and investor, they've done an asset allocation. They've decided what part of the money they want in equity and what part of the money they want in fixed income. And then the only equity piece is what they are giving me. And to that extent, we don't take cash calls. Having said that, we are at times gradual. If we really feel that the market is very heated up, we'll start with a 60% invested and go to 100. We also have an option of STP. So I don't want to take a cash call, but between advisor and investor, if they decide, no, I want to be more gradual, you can always do a 3-month or a 6-month or a 10-month STP. That's an option you always have. But we are removing confusion. I'm only doing stock selection for you, for the investor. I'm not doing asset allocation because the belief, the underlying belief is that both the investor and advisors have done enough as far as asset allocation is concerned. Then in about building in the portfolio construction, once we have identified the stock, then we are at times 100% on the day one. We know what weightages we want, 98% day one. But in certain times like this, we were 75% invested, 70% invested. And we're waiting for the correction, which we are now getting. So for many of the new investors who would go in and become 90-95% invested by the end of this correction. That's the thing.
Sure. Thanks, Anand. How do you, I can see your pipe and contra portfolio, you are running a PE of 11-12 there, right? That somehow, to someone it could be value, and for someone it could be a value trap also. How do you manage such situation? And maybe you can give some examples of some mistakes you've seen in the past or some challenges where you felt it was a value, but it went like a value trap. And how in future you are navigating such situation?
No, the best way to avoid value trap is never buy a stock for its PE valuation. PE is a derived number. It is not a desired number. So we don't target a PE multiple. If you see, my philosophy starts from business management and then valuation. So nobody in my team can start a conversation saying stock itna sasta hai. No, we don't buy cheap stocks. The best way to lose money is to buy cheap stocks. The fastest way to lose money is to pursue cheap stocks. Cheap stocks are cheap for the reason. Right. But invariably, you will lose a lot of money by buying cheap stocks. With that caveat, I'm telling you that 11 PE on our portfolio is not a desirable number. Our portfolio is not a value portfolio. Our portfolio is a quality portfolio. But market is not ready to give. So the same portfolio will be 20 PE multiple and we might be continuing to own that portfolio. Please understand. So it is not that we are desiring or we are selling a 11 PE portfolio. 11 PE is an incidental thing. The more important thing is delta EPS and ROE. I think we are pursuing strong earnings growth rate and efficient use of capital. Once we have that, we know the PE multiple is just a derived number. It will eventually, at times it takes 2 years, at times it takes 4 years. It is how long that stock has suffered will decide how long market will become comfortable giving it higher PE multiple. And many of my stocks in the portfolio had a very difficult decade before 2020. So market is not ready to recognize that this business have turned and become fairly high quality businesses. For us, the high quality business has become only consumer facing businesses. What you have in our portfolio is a growth, quality. And incidentally, you have a low PE multiple because they had a very difficult decade prior to 2020. So it's only been 2 years that they have been doing well. It's been only in last 2 years they have been doing well. So market will take some time to recognize the turnaround and will take some time to give them a higher PE multiple. But PE multiple is not what we pursue. Sorry, I gave you a very long answer.
No, it's all right. So Anand, there are a lot of questions also coming up on the screen. I know we are running late. So there is one very interesting question. Since you spoke about downgrade in exports and we have seen trends as well as there is now the concept of internationalizing of rupee as a trading currency. What are your views on this and how do you think it is going to have an impact, or do you think it will have a meaningful impact anyway?
No, nothing. I don't think there is any significant impact in the near term or even in the medium term, but it's a journey well begun, let me put it this way. Again, these are all takes 10, 20, at times 30 years to play out. And we'll only know 20 years later whether it really plays out or it doesn't. But it doesn't impact the individual companies. Look, at the end of the day, these are more strategic moves on the part of the governments in terms of what alignment you have. So this internal nationalization of rupee has nothing to do with individual companies performing well or badly. It is more strategic in nature on the part of various governments and how they think about the future of dollar and all that. So I don't think it is meaningfully important at this point of time, but it's a journey in the right direction.
I think, Anand, we did not got answer to any of your past challenges or I think everyone has gone through their share of learnings from the market. Anytime where you expected any stock or sector to do very well, it has not played out, or it has played out very late, or it went in a very different tangent. So can you share some real-time case studies? I think that will be very interesting, without naming whatever works for you.
I think there's enough and more learnings through the journey. One of that journey is obviously not to look at PE multiple first. Always look at business and management, because all the bad quality gets shafted out, because the worst combination is a bad quality stock with a low PE. So that's a learning and which has been incorporated. The other learning has been fragmenting industry versus consolidating industry. There was a point of time when telecom was very, very cheap in terms of EV by EBITDA or a PE multiple. But there was a continuous influx of new competition. So that was another learning and incorporated in our business analysis, is whether the sector is consolidating or fragmenting. Your chance of making money is very little in a fragmented industry, and chance of losing money is very high. And telecom was learned hard way how a new entrant and somebody with a lot of balance sheet, and that you will see in next 2 to 3 years in paints, when somebody enters and somebody with a balance sheet and distribution strength enters that business, you will see how everybody will pay the price for that. So a fragmenting industry is something should be avoided. And in the same breath, a consolidating industry like cement, you should not have underestimated how much the stock can relate. I remember we used to own a lot of cement in 2007-8 or so, and the industry is consolidating. Not only your profit growth is more stable and sustainable, but the PE multiples keep on compounding, and that's the great learning that we had in the cement sector, or for that matter in the paint sector and others. But the PE multiples kept on going up till the ROE keeps on going up. So the entire study behind what drives the PE multiple has been a great learning for me for the last 5 to 7 years. I've been spending a lot of time to understand why a certain stock gets a PE multiple and other doesn't. Why within the same sector a company gets a PE multiple and the other doesn't, or why within the same cyclical industry a Siemens and ABB will get one PE multiple and L&T will get another PE multiple. So I think these are all learnings which have been incorporated in our BMP framework. But it's a journey. We've been learning. The big learning, if you ask me personally, and which is a positive learning, is how we withstood the pressure to not own all these tech startups, consumer techs, and the fintechs, because we didn't believe in many of these business models, and that's a positive learning, that at times there's a lot of pressure, there's a lot of fad, but we need to withstand and stick to what you understand. I think that's the first rule in making money in the market is don't lose money. And the first rule of not losing money is don't invest in anything that you don't understand. So it's obviously not understandable, and some of retail investors will learn it very hard way last 2 days. But again, please don't invest into anything that you don't understand. Keep it simple, because first rule of making money is don't lose money.
Sure. And I know there has been a very interesting data SEBI has made it public, and wherein 90% of the traders have lost money, right? And only 1% of the people are making 50-60% of the trading profits, right? So Anand, my next question is, and I think post this forward mark note also, and that last 40 years or 20 years हम यही देखते थे कि जब मार्केट गिरता है तो buy more, right? And which is like forward marks is talking about this may not be the same in future, right? US has never witnessed a zero. Last 20 years, we have seen zero interest rate environment in US, and you are beginning to see 5 to 6% inflation environment right now, and which is getting more sticky, right? And I know, I think Naren also spoke about how this environment is very different, right? It's according to him, it's a very neutral equity environment as we talk right now. So I just wanted to know your view in this new environment where the inflation is going to be sticky and globally economies and macros are in bad shape. Would you feel the old style of investing will continue, or you will require much more dynamism? Your policy of 25% churn, less than 25 will continue to do well, or you need to be different in this environment?
No, again, as I said, there's no sacrosanct number on churn. I firmly believe if the portfolio needs a churn, we have to give a churn. But coming back to the first question, yes, the environment is very different. The environment is one where inflation is here to stay because there has been massive underinvestment globally outside China on manufacturing. The world depended on China to manufacture for the rest of the world, and they did well for a decade and a half. Now they are not going to do it, and the rest of the world doesn't know how to do it. So there's going to be a period of a very high inflation, and that's a good news for an asset owner. That's a good news for a manufacturing entity. So I think we are cognizant of what you're saying. We are very, very cognizant of what the environment is. The world will need more manufacturers. The world will need more assets being put on the ground, be it cement plant, be it steel plant, be it aluminum plant, be it power plants. And to that extent, classical asset-heavy businesses have been outperforming by 30-40% versus asset-light, no asset businesses with the technology. They are all suffering because the consumer-facing businesses suffer from a high inflation as consumers pull back. So there's very clearly is what in a way I tried to cover in the early part, that the trend has changed. Are you sleeping? Are you awake? Are you cognizant of the trend change that the ultra low inflation exported by China is behind us, and to that extent the ultra low interest rate which we lived in because China exported deflation is not there. And if that's the case, then what are the assets you want to own? Whether you want to own equity, you might want to own lesser equity than what you owned in last decade. Then within that lesser equity, what do you want to own? You want to own more asset-heavy businesses where you have inflation benefits the valuation of those assets. The replacement cost goes up. The same assets generates much more cash flow in manufacturing, in infra, in utilities. So yeah, that's how I see. So maybe we might not need to churn because we believe this cycle is going to be there for 3 to 4 years. But if need, we will churn. I mean, there's nothing. There's no aversion for a churn. I don't know why churn has become such a bad word.
Yes.
Unless it is rambling, it is illogical. I think churn is not a bad thing.
Yes. So I think we are running out of time, Anand, but we'll take a couple of 2 more questions. I can't see further questions. So I will have one question is, it is very important to time the cycle in small and mid caps. That's what my experience has been in last 15-20 years of looking at small and mid caps, as the drawdowns could be much higher compared to large caps or the blue chips, right? Are we at the right stage of cycle to deploy capital in mid and small cap? Or you feel, I have seen strategies like booster or value investing strategies, which should aid the deployment when the valuations are much more sane. What do you think is the right strategy to put money right now in mid and small caps?
So again, to speak generally about the index PE multiple is useless. You can see how portfolios can get created. I have my peers who have a 70 PE portfolio, and I have my portfolio which is 11 PE portfolio. So, you'll have to study each portfolio for itself. Coming back to your question, I think timing, apart from timing, I think time in the market, as I shown you before, is always more important. So if you were to invest in mid and small cap, come with a much longer investment horizon than otherwise normal. So I'm sure you are the best, representative and the best advisor that an investor can get. So you know better than me. But yeah, come with a higher time horizon. If need, do a longer STP. What I'm saying is, if you don't like valuations today, you don't like, please understand valuation of the portfolio, not valuation of the market, because you're not going to own market. When you're coming to me or to any of the service provider, he's giving you actively managed portfolio, which is very distinct from the benchmark. So study the portfolio. You find it very expensive, but you still like it, then do an STP. If you don't have a valuations problem the way it is in our case, then you can do a lump sum also. But that's the point. To me personally, expand the investment horizon when you're coming in mid and small cap. As Tarun rightly said, that it is more volatile. Do more STP, have a longer investment horizon, and the most important, come with a expectation of volatility so that you can sleep well. But the challenge is you come in a big way into the markets expecting कि अभी तो चलने वाला है, and that is when market tends to correct and upsets all your equations. So whenever you invest, come with the beliefs that the markets are going to correct. So you always keep some money by the side so that if there's a correction, you can deploy more and benefit from any correction. And if the correction doesn't come anywhere in 3 months, 6 months time, you can always deploy that money.
Sure. Anand, would like to know about you more, how you keep yourself ahead of the curve, right? How has been your journey, right? Because you are in a knowledge-driven business. So something about you, what keeps you moving? I think what's your passion? Anything apart from investing or anything which reading, any books which you like, anything you want to share about yourself?
I think first and foremost, reading is a part and parcel of the job, and to be very honest, markets never bore me. So I read 6 to 7 hours a day and unrelated stuff, because we really need to read unrelated stuff, and that's where it basically helps us to make a more right decision. So we read all sorts of subjects, and that unfortunately for me, I enjoy reading and I enjoy doing this job. Very few jobs which give so much of satisfaction. So that's there. I think outside that, being a sportsman all along and continue to remain a good sports freak, varied sports I can play and I enjoy. What else? I think to stay ahead of the market and stay ahead of the curve. I think the biggest strength and the biggest leeway I give to myself is I give myself time. The moment your investment horizon increases, you can take many more right decisions. The moment you squeeze yourself saying you have to go right next 3 months, we invariably have seen. So every time I have taken a decision saying this stock will do well in the next 1 year, trust me, it has not worked. And every time we have said, look, this stock might not do well for the next 1 year, but it will do very well in the next 3 years. More than 50% of time, those stocks tend to do well in the next one. So I think the learning plus the only way to stay ahead is have the longer term horizon in mind. You can do many more right decisions. You will make less mistakes. I think investing is all about making lesser and lesser and lesser. Target zero mistakes. I think don't lose money, you will make money. In a country like India, where the economy is growing at 12%, the markets grow at 13-14%. If you don't lose money, you'll make money, right? So just don't lose money. I think that's a first and most important step in the investing. Don't lose money, you'll make money.
So I've read a very beautiful quote that long term gives you flexibility. A guy who is more long term is more flexible, right? Flexibility comes when you have long term, right? A guy who is more short term or who has a 1 year horizon, he's not able to be flexible, right? Because he can't change tack, right? So as you rightly said, so yeah, it's very interesting.
No, many good investment decisions were very difficult decisions in the short term.
Right.
And it's only because you had a long-term horizon where you could go wrong in the next 3 months. We could take those decisions then. And I look back. So if I didn't have a long-term money, I could not have bought many of stuff which we could buy and which on the hindsight were brilliant investments.
Sure. Thank you so much, Anand. I think an evening well spent with glitches, but I can assure you that I have learned a lot while talking to you, and I am going more rich after talking to you. Thank you very much, Anand, for sharing your heart out and giving honest answers to all the questions. So thank you very much, and thank you everyone for joining us. And sorry again, apologies for the delay from our side. Thank you very much. Thanks, Anand.
Thank you, Tarun, and thank you everybody.
Thank you.